Good afternoon. A number of people have told me that it might be difficult for them to come tonight because this afternoon because of the events, the demonstrations, and I'm going to very briefly do like I usually do, which is first a very short summary of last time. We had a problem last time because the video was not set up on YouTube very soon after the lecture. There was some break there of I think about 6 weeks or more. But the video from that last lecture is on. You can find it on the VUB site, and it was devoted to different views that Aristotle, the very ancient philosopher from the 4th century BC, had the thoughts he had devoted to the economy, to price formation, and all these issues which are relevant to us today. And I mentioned in passing that when, in my own experience as an anthropologist working with populations of fishermen, I had to account for the way that prices were formed there in the field, either in Europe, on an island of Brittany where I lived for 1.5 years, or in Africa, that actually I found that the best methodology for explaining how prices were formed, I mean that they would fit the model as opposed to the law of supply and demand, which is the current view. It was Aristotle's model that was turned out to be relevant. There is a Samenvatting with where I devoted a couple of pages to that lecture, and you can find that on Poincaré. But today we're going to talk about an issue which may sound at first sight, no, not sound at first sight, that would sound like being slightly off the subject of ethical finance or stewardship of finance, finance at the service of the community, which is the issue of wealth distribution in our societies. And why is it actually very relevant? Because we will realize in the process that there are very different ways of looking at the ways human societies operate. And these very different views will lead to different conclusions, probably, about what is ethical and what may not be ethical. So it is very much relevant, I would say, at the highest level, most upstream level, to what we're having in mind. There will be quite a bit, I would say, of historical material this afternoon, but it will be very much located, I would say, essentially in the 19th and the 20th century, because that's where the debates actually took place around these issues. They re-emerge now. They're very much again in the news because of the events of 2007, 2008, which seems to suggest that looking at that framework again may be very relevant now. And as you may see, it might be more than just the financial events, because a reflection about, I would say, the human species on our planet and the limitation of resources is an issue, as you realize, which is which is relevant altogether, and that we've become aware since probably in the 1970s, where views came about the questioning the necessity of growth on our planet, essentially because we've become very numerous. We are now 7 billion at the surface of the Earth, and as we know, a lot of our activity may be damaging to the environment, and not only simply to nature around us, but to the very conditions of our living on this planet. And that will be the subject very much that I will be devoting a whole lecture, the final one in our series this year. The starting point for understanding how there are two very different ways of looking at human societies is, I will locate in somewhat unexpected place. When you think of the activity of human beings on the planet, and that we produce things in order to be able to consume them later on. One possible approach, doesn't see man as a major, I would say, crucial element, but just as an element which happens to be there in a process that will, how would I say, conduct it on a particular path which may be different if human beings were not there. And this may sound a bit abstruse, but you will see immediately what I mean. If a seed of grain falls on the ground, it may very well grow on its own. And there may not be human beings around at all. And for that reason, it will just go through the process. There will be more grain will be produced that will fall on the ground later on, and more of these plants will be reproduced. But human beings may be around, and they may be consuming that grain. They may actually put the seeds deliberately in the ground, look after them, and at some point harvest them and use this for human consumption. And if the activity is sustained and is reproduced every year, some of the seed will be set apart in order to be planted again and produce more of that grain for the following year. Now, if you look at the process this way, you realize that it may very well go on its own without human beings being there around at all. If you think about agriculture, which is the second example, but with human beings being there and maintaining the process, I mean, channeling in a particular way, harvesting, and so on, keeping some grain probably in granaries, and the following year putting the seed in the ground, and so on. If you look at that process in that particular way, the falling of the rain, which will be necessary for the growth, the coming of the sun, which will be necessary to have the seed mature, will be the same in both cases. That's not something that we actually have any power about. The coming of the sun rays, the photosynthesis process that will make the plant grow, the rain which is falling from the sky and helping the process to go on. The German philosopher Hegel described that activity, saying that in that particular perspective, you see man as being essentially a catalyst of a process that goes on its own, but by domesticating it through agriculture, man is in that process a catalyst of the process because he ensures that it will happen. And as you know, he will remove weeds in the field. He will manage that the concentration of that grain on a particular field will be much higher than if it was left to nature on its own, and so on. So if you look at things that particular way, you see a process that may happen without human intervention and with human intervention. People have been looking at the economy. This, I mean, what I refer here in Hegel, this is not something he's devoted a lot of consideration to. It happened, he discussed it in a couple of places in different books. But in the beginning of the 19th century, some other people have really started to think about it, I would say, thoroughly in the perspective of trying to understand the distribution of wealth which goes around a process like that. Because in the case I mentioned agriculturalists being there, but you may imagine situations where he's the owner of the field, or he's hired labor to work on that field, or he's actually in a sharecropping contract with an owner in doing the process, and so on. And I've already referred to, in previous lectures, for instance, to sharecropping. Sharecropping means that there will be a distinction between the agriculturalist and the owner of the land. The agriculturalist will not be the owner of the land, and there will be a contract between the two. And the contract, just to mention a very simple one, will be a 50-50. The owner will receive 50% of the crop, of the harvest, and the agriculturists will keep the other half, and that's one way of dividing the crop. And as I mentioned as I noticed when I mentioned that the first time, this is a system which The very definition of the share will depend on the local power balance between agriculturalists who are free hands and owners, landowners, and so sometimes it may not be 50-50, it may be 70-30, and that would be, that would determine the relationship between the two of these the persons. I mentioned also that if it happens that the sharecropper needs more hands, he will hire people and may pay them on an hourly basis, on a daily basis. But the very essence of that system, as you realize, is that the risk is being shared. If the crop happen to be very, very low, the harvester, the agriculturalist, will receive less, but the owner will receive less also, because he only gets a share of what is being produced. If the agriculturalist would actually pay rent, the rent may in some years be too high to higher than the produce of the product of the land, and in which case there will be real difficulty. In the opposite way, if the harvest seems to be a miracle harvest, the owner will benefit too, but the agriculturalist will also. This is a particular approach, as I said, which has been very popular among some philosophers or social thinkers in the beginning of the 19th century. What I've been describing here, you could actually find in the writings of Saint-Simon. Saint-Simon is French, regarded as a kind of ancestor. I mean, the word socialism was not mentioned at the time, but he may be regarded as an ancestor of socialism, and quite interestingly also because of his very views about the market as needing to be a very free market. He has a very laissez-faire approach to a market. He's also regarded as one of the main original thinkers of liberalism, which is maybe sounds a bit surprising nowadays, but at that particular time in the 19th century, the views which were developed around the idea of social progress, of technical progress, were very much mixed in that respect. I will come back also to a bit later on when I will have mentioned the second option that will explain why Saint-Simon is at the same time a liberal, very much a liberal in the way we use the word now, and a socialist in being as one of the real precursors of socialist views. Another person who looked at things in that particular perspective is Proudhon, Pierre-Joseph Proudhon. And that's interesting because he's regarded as very much as the precursor of anarchistic views, showing how thinking, how would I say, social thinking at the very beginning of the 19th century was actually producing a lot of these very alternative views, which we are interested now. So just to summarize that particular approach sees essentially man in production as being a catalyst acting between different elements which are very much produced by the earth itself, by the planet on which we do live. If you think about a productive activity involving let's say the melting of metal, things of that type, well, here again nature has provided because the iron ore will be in the soil. It will have to be dug out by work, but it's essentially a given also, like wind, rain, sun, very much a given of nature. So this is one particular approach, man as a catalyst. And when you think about what has been produced at the end of a manufacturing process, let's say, or agriculture or something of that type, if you look at that, you see very much a number of elements which had to be put together, and I will mention some others later on that had to be put together in order for that manufactured product or for that harvest to have been produced. Then in the actually in the 17th century, it was mentioned, I would say in a very crude form by William Petty. William Petty is one of the first real statisticians. I will mention him also next week because he's at the very origin of the reflection about insurance, and I will say more about him. But he's very much at the origin of the view that, contrary to what I just said, men's labor is, according to him, the only element that's actually producing wealth. The view was taken again in a much more, I would say, systematic and developed view by David Ricardo, and one of the early economists writing essentially in the 1810s, 1820s. Ricardo is very much the person who's developed most of the views that we assign currently today at Karl Marx. Karl Marx, in his writings, is very much pursuing on the I would say on the elements that have been put together by Ricardo. A lot of time he's criticizing Ricardo on some aspects. But if you think that if you think of Marx's economic text, you can very well see them as being a critique of David Ricardo, knowing that Ricardo himself was very much seeing his own reflection as being a critique of Adam Smith. So there are elements of Adam Smith also in Karl Marx. When we think about Karl Marx's view about the disappearance of capitalism and a law of tendential what's it? The tendential drop. What's the word used? Yes, the law of diminishing profits. Diminishing was the word I was looking for. If you think of the law of diminishing profits, which is regarded by Karl Marx as being probably the reason why capitalism will disappear, it is actually borrowed as such from Adam Smith. It was already expressed in that particular way. And so Ricardo says, after William Petty, but in a much more developed way, that there is only one type of wealth creation, and that wealth creation is produced entirely by human labor. That view, as I said, is currently often assigned to Karl Marx, because he put it as I would say, one of the central element within his revolutionary critique of society, by saying that anybody else who would receive a share, who would be paid in the process of labor and would not have input very much, I would say, labor as such, would actually be in a process of predating on the person who's been working. There would be spoliation, to use a technical word, that because only the laborer has produced value. In order to do that, of course, you have to explain about these other elements, which I described as being put together in the process. You would have to explain, for instance, that you would have to say that the iron ore, is not, although it is there, I would say, potentially as a resource, it is nothing without the work that's been involved in order to make it come to the surface, to melt it in order to produce metal, and so on. You have to look at all these elements which I've been describing in the first approach as being set together. You have to explain them as having been produced only by some kind of human activity. If you think of Proudhon, as I said, was very much of the opposite view, saying that you need all these elements that need to be put together in order for having something to be produced. And very much between these two trends that I just described, a lot of the discussions in the 19th century centered about supervision. somebody who's creating a a plant or a little work unit, and who's there essentially to make sure that things work. In the interpretation of Ricardo Marx, that person doesn't deserve any salary. It is viewed that the laborers, the workers, would have done the job just as well without him, or even better without him, because he's probably producing some resentment that will have to be dealt with, which is a loss of energy, and so on. The people from the first approach, Saint-Simon, Proudhon, would have underlined that supervision may be very well actually needed in order to coordinate effort. And Proudhon drew the attention on the fact that the collaboration between people needs some kind of organization which goes beyond just simply putting together some workers in the same place working on something. And the example he gives in one of his writings is that of the obelisk of Luxor, which was erected on the Place de la Concorde in Paris. And he says the following: there were 200 soldiers who, within an hour, managed to erect that obelisk on the square. And he says, but if we had asked one soldier to spend 200 hours to do it, he wouldn't have managed to do it on his own. Now, of course, you can think that with some pulleys and with some very clever device, he could actually have done it. But we understand what he means. He says there is something that we confuse often with supervision, which is simply organizing some labor as being collectively more productive than otherwise, and that is something that also, if it's done with talent, that needs to be paid for. He says there might be spoliation in some respect, in that the benefit of people working collectively may be actually predated by somebody outside, although, and he was very much one of the early promoters of what we call cooperatives now, he says they could have done it the same without a boss, and that collective effort, the benefit of it, could actually have been divided between them, and they would have benefited of that collective effort in that particular way. Proudhon used the word aubaine in French. He says, well, the wind and the rain that comes down from the sky, and the sun rays, these are all aubaine. In English, you would say windfall. It's a benefit. It's a particular benefit from just. It's some benefit which has not been, would I say, devised on a particular purpose. It happens to be there. But then, I'll come back to that later, he calls also private property une aubaine, a windfall, and I'll come back to that particular point later on. These two views lead to different political way of looking at things. Because if you think of the 19th century, these two strands I just described are very much man as a catalyst, or labor only being the creation, being the source of wealth. It led to very different approaches about what you need to do in order to change things within the economic system. And these tensions arose within the First International. The First International was the first international organization of workers, as you may know, and it very much split in the mid-19th century along these two lines that I've been defining. Why is that so? Well, because these two different approaches have politically distinct and quite opposed consequences in order of how do you want to make society evolve. If you think there are tensions within society, and I'll come back to that too later on, because economic theory developed a totally alternative view to the two approaches that I've just been delineating. If you regard man as being a catalyst in the process, and that you need, in order to produce something, to gather a number of elements, and that some things will emerge on their own, like that collective, how would I say, the benefit of working collectively on something, You may think that the way of relieving tensions in society would be just to blend the issue, mix the issue in such a way that people would be able to benefit from the different approaches to things. Think of the cooperative. I just mentioned the issue as being something that was very much in the line of what Proudhon was thinking. Well, if you think it's annoying that to have a boss who's telling you how to coordinate things and that resentment emerges because of that, be your own boss. Work in an environment where all the workers work together and where you share the supervision task, and therefore there won't be a particular issue. In the 20th century, a number of approaches, very often inspired by the church, by Protestant or by Catholic churches, have put the emphasis on this particular type of approach. In French, it's often called participation. In participation, well, you are the owner of your company, you are a shareholder of your company, you are the worker of your company. We do it all together, and for that reason, there is no opposition between different roles within different functions, because every one of us is doing all these different functions which need to be there because you need to gather a number of elements. I didn't mention the capital which needs to be produced. Well, the corporators are bringing their own capital too. They have shares in the company, and that's the way the company works. If you think in political terms within the other approach, where there are people who work and these people deserve to share the new wealth between them, and that there's no justification in your mind for paying anybody else for being there, either for having brought some resources as capital or by lending his land or whatever. And if you think that the task of supervision is something that doesn't deserve to be paid because actually you could do without or you could do it on your own, then this view of trying to mix the different functions by you being at the same time worker and capitalist and so on doesn't make any sense, because it's only the work that's producing value, and anybody who's getting any share on what being produced is actually spoliating is actually predating on the creation of wealth that took place. How do you solve that issue in that case? Not at all through organizing cooperatives or things of that type. You remove the relationships within society. You remove private property, for instance, which removes the issue of bringing capital. You create, or you strive at creating, a society without classes. And as you know, in the revolutionary approaches, which is not those I just mentioned, in the revolutionary approaches, you need just simply to essentially to get rid of the organization of society in class, which may be, like in Marxist approach, by calling for a dictatorship of the proletariat, of the workers, in order to remove class division between as being essential. What would I say, an essential element, a crucial element of the working of society. So you see, I started by looking at these two different approaches, and it looked probably like very innocuous, but as you see, if you draw the consequences of these two different approaches, you come up with a very different view of how to go about the political process in order to remove tensions existing in society. Either you make it such that everybody is belonging to all the different classes existing, and therefore there won't be any resentment, or you remove the class organization altogether, which can only be done there probably through a revolutionary process. So reform against revolution. If we think now about how people have thought about these issues in order to, and now I'm moving more towards economic theory, and economic theory as being at the same time, how would I say, the intellectual structure within which management, the running of businesses nowadays is actually taking place. Then we need to go into the way that very much that thinking developed. And in a very interesting book, which has been a reference about economic theory for, I would say at least until the Second World War, a book by Charles Gide and Charles Rist, which is called a history of economic theory. They draw very much the attention on the fact that that split that I mentioned led to a further split in order to how to think about our economic systems. If you agree on the principle that general interest should prevail on particular interest, you have to define, and that's where the connection with ethics is actually coming in. You have to define what is the general interest. And as you can imagine, the very precise way you will define general interest will very much lead to conclusions which may be very different just from having changed one word or maybe even a comma in the way you define general interest. All these people I've mentioned so far come in a category, I would say, where, as you realize, there is an emphasis on labor. Either you say labor is the only thing that creates wealth, or you say it's a very important process of an overall global process where work operates as a catalyst, but it's still very much there. If you look at the general interest as being the general interest of the person who works in the economy, you have one particular way of looking at things, and you will look very differently to people, whatever the case. I mean, whether you adopt let's say, the Marxist approach or the liberal, socialist, anarchist type of approach, you will still think that labor is a major way of looking at the economy, and that if you define what is the general interest, you may very much think that the general interest may very much coincide with that of people who are working. But in our systems, in our economic systems, as you know, some people gain access to resources, they're being paid without working. One way of doing that is having capital, lending it, having the money returned, and some interest being paid in addition. It's called the capital gains. It is money that you're making by having resources that you lend. In the example I gave originally, the landowner doesn't input work, he just lends some resources that he has. And if you define a general interest of being that of the laborer, the worker, you have to think also of how do you define then the interest of the person who doesn't work but gets a share of the wealth being created in that particular perspective. You would say in that case you would probably identify the general interest of being that of the people who work in order to get revenue, and you will regard as a particular interest the interest of the person who's gaining on the property of capital. But there's another possible approach, and that's why I mentioned that other approach, is that has become totally prevailing, has become the main view within economic theory, which is that general interest is not of the person who part of the production process as being a worker, but the general interest is that of the consumer in the process of distributing the existing wealth among the population. And in that view, if you define the consumer as being general interest, then you will have to define the producer, the worker, as being something special and probably a particular interest within that particular setup in the society. Now you see the political consequences again will be very much defined by the way whether you look at things in one particular way. If you regard a consumer as being identifying, incarnating the general interest, or whether you regard the producer, the worker, as incarnating it in the process. Why is that so different? Well, we use nowadays phrases like we call our economic system, we call it capitalism, but we call it also market economy. And very much, I don't know, when you watch television, you listen to radio, you read the press, you will see a lot of people using them even as synonyms. You say, well, this is a capitalist system, which means it's a market economy and so on. But if you've followed what I've said so far and some of my previous lectures, you heard that if you think in terms of labor in the process of producing something, and if you think that resources have to be brought into that process, it may be not there because we live in a world where there's private property and some of the things may not be, available, and that you will have to pay rent. Rent in the double sense of the word. Rent is being, paying like you pay the rent on an apartment, or la rente, as you say in French, which is the what you pay to a landowner. If you look at, therefore, as capital, capital is essentially in our societies something which is brought in order to support a productive process. If you mention the market, well, the market has not much to do with production. The market intervenes at the later process. Once the merchandise, once the product, once the good has actually been produced and needs to be distributed within the society. So therefore, when you say that our system is capitalist, you're very much putting the emphasis on production. And while you mention that as being the market economy, you actually emphasize the way that the products will be distributed within society from the producer up to the consumer. Consumption being a consumption that may be destructive. If you produce fruit or vegetables, they will be eaten, they will disappear. If you produce paintings and then they become famous, well, people will try to keep them forever. They'll keep in private collections, they put them in museums, and they will not be consumed. And when somebody like the other day in Lille draws some graffiti on a famous painting, it's regarded as a major issue. If you look now at the process of redistribution of wealth in our society, you have to keep in mind that distinction I just made between production and distribution. Because there's a tendency, as I said, in the same way as we seem to mix market economy and capitalism, and we call profit, I would say, any amount of money which is being produced somewhere, things get very much confused. I think the way to start is the way I described, because that template, that pattern, that very much the template is still very much the one that I described from sharecropping. Let me think of let's say a small business. There's a person, a man or a woman, full of energy, which has a lot of ideas about what to do. Has the spirit of entrepreneurship. That person is going to start a business. That person may not have all the resources necessary in terms of capital, the money needed, in terms of the tools, having the factories, having the ways to bring the ore, if you're melting it in order to put metal and so on. And that person will have to turn to what it used to be called a capitalist in the 19th century, and it's called an investor now, or a shareholder, somebody who's got money that can be lent in part as part of the product of the part of the production process. And now, as I said, when I mentioned the example of the sharecropping, I said maybe that the sharecropper at some point has too much work that he or she cannot put together, and will hire some people. They would be paid not and as a pro rata of the harvest or the money that's been produced, but being paid for the time being spent. That's the proletarian in the terms that were used by Robespierre, then later on by Karl Marx, the person who's actually just being hired for the work that he or she can produce. And having these three people in mind, we have that, it was sharecropping, but you can look at the small business in the exact same way. Some money needs to be brought in. Somebody needs to be there to have the idea, the concept, will do the supervision, will coordinate, orchestrate the collective work that's been produced. And that person may hire people on the basis of an hourly salary or a daily salary or a weekly salary to work in the process. Now, if you think of, I will not go in the details of that immediately, but I will define something which has been called surplus, right? Surplus is, let's not be too specific just right now about what's surplus. Surplus is the newly created wealth, riches by and that process. If you think about how it is divided, and it is very relevant on a day like this, when some people are demonstrating in the streets, really to, I would say, underline, to stress the different aspects of what I'm going to describe now. Let's say that little business, the product is being sold and there's a surplus. Now, the first bargain, the first discussion will be between the boss and the people who've been lending the money. They will define how there will be a first division of that amount between them. As I said, it used to be that it could have been a classical contract, like, it's 50-50 or 70%, 30% or whatever. Or in the case, just to mention a case from West Africa where I worked, there will be a share for the guy who is the owner of the boat, one share for the one who is owner of the engine on the boat, one for the owner of the nets being used, and so on, and some shares for all the people who have been working in the process. Also shares for the people who will be taking the nets back to the village. One share for the women who will have carried all the fish from the boats into the place where the fish will be sold, and so on. So you have that. If you think now of in terms of when you say 50-50 on the crop, well, you can imagine very well the landowner as being drawn by a carriage, receiving half of the harvest very well. The grain itself will be brought to him, and that's the way it was traditionally done. If you think about fishing, well, it would be could be the share of fish, but you can also decide that the sharing will take place after a process of selling first, and instead of the shareholder in a boat receiving fish, that he can receive actually money from the proceeds of the sale. Same thing with the landowner who's in a relationship of sharecropping with a sharecropper. He may say, well, sell the harvest. I don't want all that grain. That I will have to look after that, sell it, and give me half of the money. That's been the proceeds. That operation of saying, okay, you sell it and you give me some money, that's exactly the process that led to the payment of interest. And in the same way as I said that the definition between 50-50 or 70-30 is the consequence of the outcome of a power balance between the two parties. In the same way, within our economy, and even if it's not discussed business by business, you can see very well that within our economy, the money being paid as interest is very much a process of bargaining between the different actors within a society. And you will see, if you look at the economy, when you will see the interest rate rising, But here you have to make a distinction. The interest rate may be rising because there's the risk premium of not being reimbursed is rising. If you think of Greece in 2010, it's not because the economy in Greece was going well that people were asking a higher interest from the payment from buying debt from the Greek. It's because there was a risk they would not pay back, and that risk actually materialized because indeed at the end of 2011 we decided that not all the money that had been borrowed would be reimbursed. But if you look at economies that go very well, you will see that the interest rate will rise, and that will be the same as the shift going from 50-50 to 70-30. It's just because the economy going well, it is easier for those who borrow to pay more to those who are lending the money because there's more riches being produced. So the first power balance you have to look at, if you think of that small business I have in mind, is the one between the owner of the business and the person who's been lending money. And the relationship between them, the power balance between them, will decide to some extent to the how much interest will be paid. And as I said, I mean, we don't do it now business by business. There is a general climate. When the economy goes well, there's a tendency overall for the interest rates to go up because there's more it's easier to depart from a larger part of the capital that's been lent. Once that process, and of course I'm talking of things that are simultaneous, but I mean just, how would I say, intellectually, theoretically, when you're looking conceptually, I want to say conceptually, when you look at it, once that power balance has been resolved between the boss, the owner, the entrepreneur, and the world of business, the capital, then there's an order bargaining going on, and that's the one which is very much in the news today, between the boss and the employees. Because now a division of the benefit will need to be decided. How much will the boss keep for himself or the other bosses in the company or the executives, and how much will be given to the employees? And we know that if we look at the trend, let's say on the period 1975 to current, we know that in the West, United States and Europe, that in that particular respect, the wages of ordinary workers who are paid on a daily basis or an hourly basis has remained stagnant, while the share of the owners and the executives, no, I don't mean the owners, of the leaders or the executives of the company has gone up by a lot, and that explains that change in that factor, which was around 40 in the beginning of the 20th century, a factor of 40 between the least paid in the company and the highest paid in the company, and that has moved now on the average in the Western world to 450, more than multiplied by 10. And that reflects very well a change, obviously, in the power balance between employees and the executives in a company. So I think we got three parties here. We got the capitalist investor, we have the owner of he was called most of the time industrialist in the 19th century. We call them entrepreneur now, from the American term, which is actually a very older term from French, of course, the executive in the company, and you have the wage employees, people who are being paid wages. Now, this is not the only actors within a company, because there's also something which is properly profit. I mentioned the surplus, that surplus that will be divided by all these people that I mentioned so far. And that surplus, as I said, I wouldn't define it right away because there's an issue there. How is it determined? Well, there's a cost of all the elements that you put together, the salaries you've paid to people, the rent you've paid to the capitalists, the wages you've been paying, and the bonuses you've been paying to the executives in the company. And where does that surplus come from? Well, it's the difference between all these costs put together and the price at which you've managed to sell. Sell for the first time to an intermediary, to a wholesale dealer, to whoever. But when there's a factory, let's imagine now a factory, when the product comes out, it is sold to, it can be sold right away to the consumer. If you're a fisherman and you, instead of dealing with a fishmonger, a wholesale dealer, if you take your fish in a basket and goes along the quay and sells it to passers-by, well, there are no intermediaries. You're selling it right away. But most of the time in our societies, there are some intermediaries. People who produce some merchandise, they don't sell it right away to the consumer. It's more and more easy nowadays through the internet. But there's a current scandal in the news about horse meat having been sold as beef meat. You may have seen that, and it's quite interesting and revealing when you listen to the news or you read about it to see what intermediaries there have been between the person who actually slaughters a cow or slaughters a horse and ending up in the lasagna. I won't go into the details nowadays, but there's a lot of what is striking, and somebody wrote a very good paper which is on what's set on my blog today, about how much the process has become a financial process recently, rather than being really centered on the product itself, on the meat which being sold. The surplus is the difference between the costs in the production process and the first time it's being sold on a market. It's difficult to define it very precisely, because unless you have a business which is the only one in the world producing that particular commodity, and in that case, well, you define the price at which you will sell, and that you will have defined your surplus yourself. Otherwise, we're part of a competitive process in which a factory that produces, I don't know, cameras is in a process of rivalry and of competition with other people produce cameras. And therefore, it will be the market, the primary market. The primary market is the one that puts together a producer and a first-time buyer. There is a competition between producers, and there's competition between buyers, and that will define the amount at which the product will be sold for the first time. So you cannot simply have an equation and say, okay, the costs of having produced the good is so much, and plus the surplus that you can easily calculate, and that will define what will happen in the distribution of wealth. No, it is a market process, a first market process that will define how much that product can be sold, which will be reflecting going down as being the surplus of the company. Now, there's more than I mentioned. There are intermediaries. Most of the time, there is a secondary market, and on a secondary market, that thing that's been produced, that good, can be sold, I would say, an infinite number of time. There are some constraints. If it's something which is perishable, if it's bananas, you can't go on forever selling it. At some point, it will mature, and you will have to sell it before it's too late. So you have to, if you want to sell it to, if there's a large number of intermediaries, it needs to go very, very quickly. But otherwise, let's say for a painting, the painting which is famous, it can go on being forever being sold. And as if you follow the news about famous paintings being sold, you will know that in this particular period, well, it was resold less at the amount of money was less than the previous time it had been sold. The next time it will be sold at 10 times as much as the previous time, and so on. There's a process going on in there. When we talk about profit, most of the time, that's what we're talking about. We're talking about the profit in the commercial process of the merchant. We can call the merchant, which is a traditional term. We can use the term trader also. Unfortunately, recently we called traders essentially people who are doing bets in the trading rooms in banks. But a trader traditionally is like a merchant. It's a person who actually doing the process of distribution within the economy and is selling at a higher price than he has been actually acquiring him or herself the product, and that's how that person is making a living. So we have now four types of actors. If we need to be complete, a lot of people are civil servants in our societies, and you would have to talk about civil servants also, which is, or most of the time they're just simply wage earners, but they're wage earners within a particular system, which has some advantages compared to the rest of the economy. It's less competitive. If you're out of a particular job, you're still being paid because you're simply employed by the state, and it's the responsibility of the state to find you some particular employment, and if the state cannot do it right away, you will still be paid until the state is making a decision about how to use you for in the best possible way. I've put together all the elements which allows us now to move, let's say, to an issue which is really very much central to what we're talking about here. If you look at the history of economic thought, and I've already mentioned that, there are very much two periods. The first period is called political economy, and the second is called economic theory or economics. And the turning point is very much around the years 1870, 1875, in the final quarter of the 19th century. I've already referred to that turning point, but the way I want to look at it today, but because it will be in line with what I've said before, is in terms of the actors of the economy. If you look, for instance, at François Quesnay at the end of the 18th century, one of the very first, we would say, economic thinkers working in France. He's analyzing, he's producing a tableau de l'économie française, a table of the economy, French economy. We could call it very much a graph nowadays, or a network of the French economy, because what he's doing is locating different types of people, like I just did. The owners of capital, people who are wage earners, merchants or traders who are making profit. This is a way of looking. I'm not looking at individuals here. I'm looking at categories of people, and that's very much the way that was done traditionally in economic thought. When you're looking at Quesnay, well, he says there are these people who are doing this, and there are flows of goods going from the people here who have manufacturers going to the people there who are traders, and these people will actually direct that flow towards the consumer and so on. His tableau is very much of that particular time. That was the way that Adam Smith was looking at the economy. That's the way that Ricardo, that Marx was looking at the economy. The words used for these groups of people was classes. You would use the word estate too, and in French you would say les états, and in the French Revolution you would call the bourgeoisie, you would call it le tiers état, the third estate. Conditions, very much if you look in the 19th century, the word which is used for the group is very much the word condition. You have it in literature too. You would say people of different conditions, and that would mean people belonging to these different types of categories within the society. If you look at what happened in the 1870s, then you know that this approach in terms of categories of people, of functions in the economy, of different type of actors, disappeared. We stopped looking at these groups for looking only at the particular individual. And if you think of what I said before, that the general interest is regarded as being that of the consumer, you would say, well, this has sense. Why look at group of people if we're interested in general interest, and that's everybody as a particular individual? Why look at things differently? And as you know, that individual which was then labeled Homo economicus, the economic actor, was regarded as a person who would allocate rare resources to alternative users by ranking these alternative users in terms of personal utility. And that would be, you would see a society now not being made of people of different classes or different estates of different conditions. You would look at a society as being essentially made out of consumers, and these consumers would be individuals who are rational in making their decisions, not rational in terms of the terms that, in the approach that would be that of Aristotle of being able to lead reasoning properly, but being rational in terms of being allocating in the best possible way alternative resources. If you look at that consumer, your approach here, your political approach of society becomes extremely different. If you think in terms of, okay, I'll take one example and I will not go into the distinctions I made before, but if you think of Karl Marx, he would say, well, there are classes in society, and these classes are at war. There's a warfare between classes, class struggle, and these can only be resolved in some particular ways, like for one class confiscating the property of another, or things of that particular type. You can, if you like Quesnay, you would not be a revolutionary, but you would think still in terms of, let's say, in terms of more modern parlance, how to best allocate these flows within the economy, so that I would say you could use the idea of a Pareto optimum, meaning that how would you best allocate in terms that making global happiness a maximum of something, or something of that type. But if you only look at consumers, and if you only look at an approach which is based on the individual instead, you will come up with a very different view. You will say, well, everybody is the same. It happens that some people are capitalists, it happens some people are wage earners, but their issue is essentially the same for all of them, which is allocating their resources in the best possible manner. So that the fact that they are owners of a company and so on, or simply employee, or even jobless, is, how would I say, not an essential. It's an accidental property of that person, but it's not essential. What is essential is just a rational person who can make rational decisions in terms of the economy. And how would you look then at that class struggle that's being the interpretation by the people who think in terms of class, for instance? Well, you would say, well, within our society, people are indeed allocated to being a capitalist or a wage earner and so on, but that's very much a natural process. That's not anything which is political or social. That's the way things are. It is a pure consequence of the social division of labor, that it's better, it's more productive for people to specialize in some particular activity. Like Adam Smith described, that you could distinguish 7 different operations in producing a pin, and you would say, well, some are better at producing the stem, some are better at putting the top of the pin on the pin and solder it in there, and so on. And it's just a question of talent, where you will end up, you, rational economic being, within society in a particular place. If you don't have much talent, well, you may end up in a job which doesn't pay much. If you have a lot of talent, then you'll be paid a lot for what you say. And when I say that, you hear immediately the discussions currently about the very high wages paid to some executives in company. Within that approach, well, there's an equation in terms of money and talent. If you are paid 72 million as a bonus, like the person who was in the news yesterday, it's because you have talent which is worth 72 million. That's not more complicated than that. And how do you explain then, when you were within that approach, to say, well, we are in a society where talent is being rewarded, everybody is a rational economic agent, but some are better at doing it than others. And if they're not happy about where they are in the society, they just have to switch. If you're not happy being a wage earner that doesn't make a lot of money, become an entrepreneur and make a lot of money and you'll be happier, but don't bother other people with your problems. In that interpretation, that particular approach, what is that class struggle that Marx is talking about? It's just resentment from people who don't get the concept of the social division of labor. They don't understand how society works. They don't understand that the social division of labor is essentially a natural process, like the birds and the bees in nature, and who develop resentment because they don't understand how that system works. Now, I've started at the beginning of my explanation of whether the wind and the rain should be taken into account in the process of production. And now I'm down to very much, I would say, the political divisions within the world or where we are, where some people say it's important to go on strike, it's important to go demonstrate in the street because the essential point is the relationship between I think it's nearly finishing, so it's very much the end.
Okay. Then we had another lesson, so political.
Yeah, can you wait then a little bit that I'm finished?
Okay.
Thank you. So we come to a point where we have very much two conflicting views about the political process. And when there was that interruption, I was saying, some people say, okay, it's important to go demonstrate because the stress, the emphasis is between that relationship between the wage earners and the bosses in the company. And some people were saying, well, if you don't like being your position in a company, become an entrepreneur yourself, and you will get out of that logic, and that will be it. The reason I've gone up from the very beginning is to see where the split begins. At the same time, if you think now in terms of ethics and in terms of what is the best possible approach in terms of society, you see that these two views are impossible to reconciliate. One is very much the one from the economic theory, currently based on the on Economicus, is actually put between brackets as being irrelevant, very much irrelevant. The notion of the private property that defines that some people will have access to more resources, capital than others, is put that between brackets. It's ignored as a particular issue. The redistribution of wealth, these power balances within companies with the profit being made by the merchant and so on. If you look at the literature in economics from 1870s to now, I mean the mainstream of economic science, I don't mean economic anthropologists like myself or people who are doing studying economics as physicists and so on, but you will have difficulty finding books dedicated essentially to the issues of the redistribution of new created wealth. That's not part of economic theory. Books devoted to private property and discussing the different issues around private property, nearly none has been produced either by economic theory. That other strand of political economy, of course, these issues of private property, this issue of redistribution of wealth were central, were very much central, you've understood. If you look at the economy in terms of the relationship between classes, there's no way you can avoid that. If you do look only at isolated individuals, you will have to ignore that particular type of approach. And you may understand better, I refer to one of the central methodological tenets, creeds of economic theory in recent years, which is called methodological individualism, which is to claim that there are no collective processes. Now, it might be a scientifically based view, but at the same time, if it's not scientifically based, you can see how practical it may be in order to not have to go into these other issues, if you assume that there's nothing more, which is what is central to economic theory, if you assume that there's nothing, that the sum is not, that the total is never more than just the sum of the elements, that nothing emerges ever as a collective process, then you're very comfortable just looking at the homo economicus and saying, well, the fact that he's a head of a factory or just doing a labor which is poorly paid is just irrelevant fact, and it's a consequence of the social division of labor. I think I've wrapped it up, this particular issue. A lot more could be said on the issue of private property. It's pretty central to current reflection, and as you may know, Elinor Ostrom, who died recently, who was a Nobel Prize in economics, was a person who had put the issue of private property again at the center of reflection in economic science. And it is to say to the, how would I say, on behalf of the committee of the Nobel Prize Nobel Prize between quotes of economy, that they've been turning to people who have not been working essentially on that in that mainstream, like people like Milton Friedman or Friedrich von Hayek have been done in the 70s and 80s. That would be, I would say, a subject to discuss on its own. Historically, you may know that John Locke, the philosopher, had a very interesting view that private property is always some kind of encapsulated work, that there has been labor at the very beginning, that there's no private property which doesn't encapsulate an element of work. The issue then that can be raised is how much work was actually involved. If it was essentially to go a place which was empty and just to put a little claim board, the work was minimal and may have given you access to a lot of, let's say, mining resources that you could have brought that particular way. Often, if you reason in that way, the work that was involved was done many generations ago. You can also, if you raise property, you have to raise also the fact that how does it allocate resources currently in our society? How is it transmitted through inheritance? And how much of that transmission to inheritance, how useful is it for the economy or a hindrance to the process, and so on. But as I said, I can only mention today a couple of remarks of that type about that issue of private property. But what I wanted to stress is that when we think in looking at the economy or finance in an ethical perspective, the framework within which we look may very well be extremely different according to what are the starting points of our reflection. And in this particular case, I was just drawing the attention to the consequences of having made just a decision from the very beginning of whether we take into account that input of nature in the production of what we're doing, or whether we decide that that's not relevant because only work is producing, labor is producing value. All right, as we've done the other times, if there's a few minutes left that we can devote to questions, and if there's anything would like me to answer. Michel?
Yes, thank you, Paul. Just maybe one question, more a reflection of mine. There are some scholars who discussed today saying that the very issue of capitalism is already ancient time discussion, and that we have seen over the last 5 years, 10 years, a further development going to what they call financialism. Shall you, in future lessons, come to that? Because somewhere I think that there is, on one hand, a major difference compared 1970s, where the ownership of a company was somewhere a very stable ownership, and where, due to the notion of shareholder value, the several owners became very, very, very quickly rotating, and where the importance of selling out, trading with the shares of companies became more important than precisely the production which was needed within a classical economy, within a company.
Yes.
That's one of the developments, but furthermore, from a regulation point of view, it appears that, especially in the United States, there were in the 1930s, 1950s, one considered that the executive board, the executives of a company, had to take into account general interest, and then your point about is that the capital or is it the labor, something which is very important. In fact, that obligation over the last 10 years completely disappeared, as you explained in the philosophy of Friedman, saying that the only general interest you should have in mind is precisely maximizing the shareholder value, maximizing the profits. So somewhere, I don't know whether that notion of financialism, what it has as consequences, will be examined further.
Yes. I think there's one lecture devoted, I don't remember, and I know it's by the end of March, there's one lecture again that will come specifically, because what I've been talking about here today could very much have been located just within the 19th century. I only talked about some, how would I say, some aspects which are current, but very incidentally, because the setup was already there. But I think we have a lecture which will be dealing with that specifically. Now, it happens that on that second part of the question, we happen to have very interesting evidence from Lord Adair Turner, who is the head of the FSA in Britain, who was asked some more specific questions about his distinction between socially useful and socially useless activities, financial activities, and he's come up with a, I would say, extremely beautiful and convincing view, very much inspired, I would say, by Keynes' view of how that whole works. Now, the fact is that it's a person here on the first row who's managed to get that interview from Christina, who managed to get that 35 minutes interview from Lord Adair, and I think it would be unfair if I talked about it. I think we should give her an opportunity really to talk about that interview that she got from him. As I say, it's a beautiful lesson really in it brings a whole portrait within half an hour of how the system currently works. I would say the most interesting aspect, he may not think in those terms, is that when he was asked about examples of socially useful activities within finance currently, he was very much at pains at finding examples. He kept coming back with more examples of what was not socially useful. And it's quite relevant to us that the only one activity that he mentioned as being socially useful was very much the coming together of the lender and the borrower in the intermediation process. For every one of these other processes, and I mentioned that when I talked about his recent speeches, when he could actually surprise us very much by giving mortgages as being an example of a useless process, because he was stressing the fact that it's essentially a process of one generation selling at inflated prices to the following generation, the same residential estate, same residential estate. As I said, so to the first part of your question, I think we definitely have a lecture coming up where I will deal with that particular aspect, which is, I would say, very much linked to the fact that there's been a proliferation of these financial activities which are not useful, even if you cannot really brand them as being useless. The other aspect is that I know that Christina will put that in her report, that interview, but I think it would be good also if we all had access to that. It's I would say it's a beautiful piece of a lecture, actually, that he gave on the subject. Anyone else? You? Yeah.
I was wondering, to what extent could you link general interest to the determinism versus free will debate? Could you do that?
I missed the end of your question.
Basically, how could you
General interest?
into the debate between free will and determinism? Could you do that?
No. I will touch on that issue tomorrow in Paris at the Théâtre du Rond-Point when I'll be giving my little Friday meeting. It's the issue you're mentioning there it's a whole book. Yeah, it would be too difficult. Trying to approach it within a couple of minutes would be. I don't think would be productive. But it's a good question. All right. Well, in that case, thank you very much for having been here, especially due to the weather and other circumstances. See you next week. We'll be talking about insurance.